What makes a company truly healthy? Is it soaring profits, a fast-growing customer base, or a stock price that climbs quarter after quarter, sheared by headlines and investors alike? If that were the definition, then the history of markets would not be filled with sudden collapses, yet it is. Time and again, companies once hailed as invincible, from the industrial giants of the 1920s to the tech darlings of the 2000s, have fallen with shocking speed. On the surface, they looked strong. Earnings were rising, analysts were optimistic, and the future appeared secure. But beneath the glitter of growth, something fundamental was often missing: financial health. Benjamin Graham, the father of value investing, understood this better than anyone. He once remarked that the investor's chief problem, and even his worst enemy, is likely to be himself. But there's a second, quieter enemy: deception by appearance. A company's financial statements can tell a comforting story, but only if we know how to read them. Graham spent his life trying to answer a deceptively simple question. How can an investor tell whether a business is truly safe, not just profitable today, but strong enough to survive tomorrow? Because in Graham's world, a world shaped by depression, panic, and recovery, safety was not a luxury, it was the foundation. He saw countless investors lose everything, not because they lacked intelligence, but because they lacked the discipline to see through illusion. Imagine the late 1920s. Stock prices soaring, fortunes multiplying, confidence boundless. Every company seemed healthy. And yet, when the crash came, even those with gleaming earnings and rapid growth were exposed as fragile, propped up by leverage, speculation, or unsustainable trends. From that devastation, Graham learned a truth that modern investors often forget. Financial strength is not defined by profit, but by endurance. A healthy company is not one that shines in prosperity, but one that endures in adversity. And so, in the decades that followed, Graham built a framework for reading a company's financial health, one that went beyond surface numbers and short-term excitement. He looked for resilience, not glamour, for stability, not speed, for facts, not forecasts. It's a framework that remains just as relevant in today's markets, where numbers flash across screens in milliseconds, but meaning is often lost in the rush. So in this episode, we're going to slow down. We'll walk through Benjamin Graham's method, step by step, for assessing a company's true financial health. You'll see how he read balance sheets like a doctor reads vital signs, how he distinguished temporary strength from permanent solidity, and how those same principles can help you, today, separate sound businesses from those that are only sounding good. Because every great investor, Buffett, Klarman, Munger, started by learning this one thing. Before you decide what a company is worth, you must understand whether it can survive. The year was 1929. Benjamin Graham was 35 years old, brilliant, respected, and by all appearances, successful. His reputation on Wall Street was growing rapidly. He had graduated near the top of his class at Columbia, joined a prominent firm, and built a modest fortune by applying logic and analysis to the markets. At the time, the mood of America was euphoric. Industry was booming. The automobile, the radio, and the airplane were transforming daily life. Stock prices seemed to rise without limit. It was an age intoxicated by progress, and Graham, though cautious by temperament, was part of that wave. He owned stocks that appeared strong. He analyzed companies with impressive earnings, growing dividends, and managements that promised ever-expanding horizons. He believed he had chosen carefully, guided by facts and ratios, not by emotion. But what Graham and countless others didn't realize was that the facts themselves had become distorted.
Behind the optimism lay excessive leverage, creative accounting, and an almost religious belief that this time is different. And when the crash came, it was not just a correction. It was a collapse. In a matter of months, fortunes evaporated. Graham's personal portfolio fell by more than 70%. His clients, once wealthy, faced ruin. The market he thought he understood revealed its true nature, not as a machine for wealth creation, but as a mirror reflecting human behavior. For Graham, it was not merely a financial loss, it was a revelation. He began to ask a deeper question, one that would define his entire life's work. If numbers, charts, and forecasts could all be wrong, what could an investor truly rely on? The answer, he found, was strength. Not the strength of price momentum or profit growth, but the inner strength of a business, its balance sheet, its liquidity, its stability. A business, he realized, should be built and analyzed like a fortress. No matter how bright the future appears, the walls must be strong enough to withstand a storm. And so, Graham began to rebuild his understanding of investing from the ground up. He returned to the financial statements, not as instruments of prediction, but as instruments of protection. He began asking new kinds of questions. How much working capital does the company have compared to its debt? Are its profits the result of sound operations or accounting creativity? Does it hold tangible assets that can support its value in hard times? Has it proven stability through a full business cycle, not just during booms? Each of these questions became a piece of what we now call the Graham method, a disciplined, almost clinical approach to reading a company's financial health. It was through this process that Graham discovered a kind of investing that was not dependent on prediction at all. Instead of trying to guess what the market would do, he focused on what could not easily be destroyed, the intrinsic strength of the business itself. From this discipline, Graham's legendary principle of the margin of safety emerged. Because if a company's assets, earnings, and financial structure were solid enough, then even errors of judgment, economic downturns, or market panic could not easily destroy the investor's capital. That, Graham concluded, was true health. And it was from these hard lessons of the Great Depression that modern investing, as we know it today, was born. Nearly a century later, the world has changed in ways Graham could never have imagined. But the need for financial strength, for balance sheets that can weather storms, remains exactly the same. In bull markets, it's forgotten. In bear markets, it's rediscovered. And those who understand it before the storm are the ones who survive after it. When Benjamin Graham spoke of a company's financial condition, he wasn't referring to its market capitalization, quarterly earnings, or the latest analyst upgrades. He was referring to something much quieter and far more enduring. To Graham, financial health meant the ability of a business to survive adversity without losing its integrity, its solvency, or its capacity to earn. In other words, it wasn't about how much money a company could make in good times, but how well it could endure the bad. That simple idea forms the cornerstone of Graham's philosophy. The essence of investment management is the management of risks, not the management of returns. Most investors chase performance. They ask, how much can this company grow? But the intelligent investor asks, how much pressure can this company withstand? Because profits vanish in a crisis. Excitement fades, but strength endures.
So what did Graham look for when he analyzed a company's financial health? He built his assessment on three essential pillars, each reinforcing the other like the legs of a stable foundation. 1. Earnings stability. The first test was simple, yet profound. Has the company produced consistent positive earnings over a long period of time, not 1 or 2 years, but a decade or more? In The Intelligent Investor, Graham insisted on a minimum of 10 years of continuous profitable operations before considering a company suitable for defensive investment. Why 10 years? Because business cycles reveal character. A company that can earn steadily through recessions, industry shifts, and market upheavals has demonstrated something deeper than skill. It has shown resilience. Graham saw erratic earnings as a warning sign. A firm that fluctuates wildly between profit and loss is like a ship that sails beautifully in calm waters but capsizes in the first storm. For the investor, steady earnings meant predictability, and predictability meant safety. 2. Balance sheet strength. The second pillar was the balance sheet, what Graham called the company's financial position. He examined two key qualities: liquidity, whether the company had enough current assets, cash, receivables, inventory, to cover its short-term obligations, and solvency, whether long-term assets and earnings could support the company's debts and long-term liabilities. He often used the current ratio, current assets divided by current liabilities, and the debt-to-equity ratio as simple yet powerful tools. Graham preferred companies with minimal debt and abundant working capital, because debt, he warned, turns time into an enemy. The chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. When conditions inevitably turn unfavorable, debt magnifies weakness. By contrast, a strong balance sheet, rich in tangible assets and conservative financing, acts like a shield. It protects not only against market crashes, but also against managerial errors, unforeseen expenses, and the sheer unpredictability of the world. 3. Dividend record. The third pillar might seem old-fashioned today, yet it remains one of the clearest indicators of discipline: the dividend record. A company that pays regular dividends year after year signals a commitment to shareholders and a recognition that profits must be real, not theoretical. For Graham, the dividend was more than a check in the mail. It was a statement of honesty. It proved that earnings existed, that cash flowed, and the management respected investors as partners, not speculators. Companies that boasted of reinvestment but never shared profits were, in his eyes, demanding blind faith. A strong dividend record, on the other hand, was evidence of maturity, the mark of a business that could balance growth with responsibility. Taken together, these three pillars, stable earnings, strong balance sheets, and reliable dividends, offered Graham a complete picture of a company's health. They revealed not only whether a business was profitable, but whether it was durable. Because Graham believed that the true test of a company's quality is not how high it climbs, but how well it stands when the market falls. And for the investor, understanding that difference between growth and endurance, between appearance and strength, is what separates speculation from wisdom. Benjamin Graham never treated numbers as magic. To him, they were like a compass, useful, but only when read with judgment. And his genius lay not in complexity, but in clarity. He believed that anyone, with patience, humility, and a disciplined process, could learn to read a company's financial health as surely as a physician reads a patient's chart. The key was to look for signs of strength and to recognize symptoms of weakness.
So let's walk through Graham's process, step by step, just as he taught his students and applied in his own legendary analyses. Step 1. Begin with the earnings record. Graham's first step was always to look backward, not forward. He wanted to see at least 10 years of operating history, preferably more. This long view filtered out the noise of short-term success. He would open the company's income statement and ask, has this business been consistently profitable, or does it swing with the tides of fashion and fortune? He paid attention to the trend of earnings, steady, rising, or erratic, the consistency of profit margins, the stability of return on equity. To Graham, fluctuating profits were a red flag, evidence of instability, weak pricing power, or dependence on external conditions. A company with 10 years of steady profits, on the other hand, demonstrated that its business model could endure. This was the starting point, the company's vital sign of survival. Step 2.
Test the balance sheet's strength. After studying earnings, Graham turned to the balance sheet, the true measure of a company's endurance. He believed that a sound investment rests not on optimism, but on strength. So he looked for ample liquidity and minimal leverage. Here's what he checked. Current ratio. Current assets divided by current liabilities. A ratio above 2 to 1 signaled healthy liquidity, meaning the company could easily pay its short-term debts. Debt-to-equity ratio. Total debt divided by shareholders' equity. Graham preferred this ratio to be conservative, typically below 50%. Working capital surplus. Current assets exceeding current liabilities by a comfortable margin. He saw this as the company's cushion against adversity. He often reminded his students that the balance sheet tells you what will happen when the business stops growing. Because when growth slows, and it always does, debt becomes a burden, not a tool. And companies that depended on borrowed money for survival were, in Graham's words, built on sand. Step 3. Determine the asset value floor. Graham's next step was what he made him uniquely different from most investors. His focus on tangible asset value. He calculated something he called the net current asset value, NCAV. Net current asset value equals current assets minus total liabilities. This figure represented what shareholders would receive if the company were liquidated, its real, hard, tangible worth. If the stock price fell below this conservative estimate, Graham saw an extraordinary margin of safety. He would sometimes buy such companies, the famous net nets, for 50 cents on the dollar of their liquidation value. Why? Because, as he put it, you are not right or wrong because others agree with you, but because your facts and reasoning are right. These were not glamorous investments. They were often dull, overlooked, or even distressed, but they were safe. Graham built fortunes not by predicting winners, but by avoiding losses, by ensuring that even in the worst-case scenario, the investor stood on solid ground. Step 4. Check the dividend record. Graham's next step was simple but revealing. Has the company paid uninterrupted dividends for at least 20 years? This record was not about yield, but reliability. A consistent dividend history proved both the company's ability to generate real cash and its management's discipline in sharing it. He believed that dividend continuity revealed corporate character, a reflection of prudence, responsibility, and respect for shareholders. Step 5. Apply the margin of safety. Once these 4 tests were met, consistent earnings, strong balance sheet, solid asset backing, and a proven dividend record, Graham applied his most important principle, the margin of safety. He never bought a stock just because it was good. He demanded that it also be cheap enough to offer protection against error.
That margin might come from a low price-to-earnings ratio, a discount to asset value, or unusually stable financial performance. But the logic was always the same. The margin of safety is achieved when securities are purchased at prices sufficiently below underlying value to allow for human error, bad luck, or extreme volatility. This principle transformed investing from speculation into discipline. It turned risk into opportunity and taught generations of investors, from Warren Buffett to Seth Klarman, that defense is the best offense. Step by step, this was Graham's quiet process, a system not of excitement, but of understanding. He saw investing as a partnership between logic and patience. And by following these principles, he gave ordinary investors a method to guard themselves against extraordinary uncertainty. Because as Graham proved again and again, you don't need to outsmart the market, you only need to outlast it. Nearly a century has passed since Benjamin Graham wrote Security Analysis, yet the heartbeat of his ideas still pulses through modern markets. The landscape looks utterly different today. Algorithms trade in microseconds. Financial reports are digital and dense, and narratives move prices faster than numbers do. And yet, behind all that noise, Graham's logic still whispers one unchanging truth. The essence of investment management is the management of risks, not the management of returns. So how do we read a company's financial health today in a world where the numbers are more complex and the noise is louder than ever? How do we apply Graham's method to modern giants like Apple, Amazon, or Tesla, companies driven by intangible assets, innovation, and brand power? Graham lived in an era of railroads, steel, and manufacturing, where value was tied to tangible assets, land, machinery, and inventory. Today, value lives in intangibles, patents, code, algorithms, and human creativity. So does Graham's method still hold up? Yes, but with interpretation. His core principle was financial strength before financial story, and that still applies. A modern investor should still ask, is this company liquid? Can it meet its short-term obligations without distress? Is its debt at manageable levels compared to equity and cash flow? Are profits real or just accounting illusions? These are timeless questions. Only the language of the balance sheet has evolved. For example, where Graham examined inventory turnover, we might examine cash conversion cycles. Where he valued factories, we might analyze R&D spending and its consistency. But the underlying logic is unchanged. Seek stability, solvency, and discipline. In both 1934 and 2025, financial strength is not what's promised, it's what's proven. In Graham's day, companies published straightforward financial statements. Today, we face adjusted EBITDA, pro forma income, and non-GAAP results, numbers that can sometimes paint a rosier picture than reality. Graham would have smiled wryly at these modern embellishments. He warned long ago that accounting is as much art as science, and that the intelligent investor must read beneath the surface. So what would Graham do? He would strip away the adjustments. He would compare reported net income to actual cash flow. He would measure earnings consistency over glamour. He would ask, does this business generate real cash year after year, or is it merely flattering itself with forecasts? In Graham's world, quality of earnings mattered more than quantity, and that is still the only reliable compass for judging a company's health in an era obsessed with projections. Today, the world runs on debt. From corporations to nations, borrowing has become normal, even celebrated. But Graham warned against this very trend, writing that debt is a double-edged sword. It can be a creator of value or its silent destroyer.
Modern investors must ask, is this company's growth fueled by profits or by borrowing? Can it withstand a period of higher interest rates or falling demand? Is its cash flow strong enough to service its obligations without dilution or desperation? Companies like Apple and Microsoft, for instance, carry debt, but they also hold vast cash reserves. Their debt is strategic, not existential. Contrast that with weaker firms, where debt is survival, and you begin to see why Graham's balance sheet tests remain indispensable. His lesson endures: never mistake access to credit for financial strength. Graham's principles in the age of tech and story stocks. In today's markets, stories move faster than spreadsheets. Investors chase narratives of disruption, innovation, and infinite growth. But Graham would remind us that no story, however beautiful, can protect you from arithmetic. He would urge investors to apply the same tests even to the most modern of enterprises. Does it earn steady profits or rely on investor enthusiasm? Is it self-sustaining or perpetually fundraising? Does management communicate honestly or sell dreams? Even with technology companies, Graham's logic applies. We simply adjust the metrics. For example, in place of tangible assets, we might look at user-based durability, cash burn rate, or free cash flow trends. In place of dividend records, we might assess capital discipline and share repurchase behavior. But the goal remains the same, to separate what is valuable from what is merely popular. Timeless relevance in a changing world. If Graham were alive today, he wouldn't be overwhelmed by the modern market. He would be fascinated and perhaps a little amused. He would remind us that human nature hasn't changed. Greed, fear, and impatience still drive markets far more than balance sheets do. And that's why his method remains so powerful. Because at its heart, it's not about formulas, it's about temperament. It's about cultivating a mind that seeks evidence, not excitement. And about grounding every decision in one enduring belief, that true financial health is not about momentum, but resilience. When you learn to read a company's financial statements with Graham's clarity, you stop seeing numbers as a blur of data. You begin to see character. You see prudence, arrogance, endurance, or fragility reflected in the figures. And that's when investing becomes more than a trade, it becomes judgment. Benjamin Graham often said that an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. But what's often missed is that the phrase thorough analysis is not just a technical act, it's a moral one. To Graham, analysis was an expression of character. It reflected patience in a world addicted to immediacy, humility in a profession obsessed with prediction, and discipline in a marketplace driven by emotion. When he taught his students at Columbia, among them a young Warren Buffett, he wasn't just teaching finance, he was teaching a philosophy of living. And at the center of that philosophy stood a single quiet idea. Strength is a moral quality. A company with strong finances reveals something about the people who built it, their restraint, prudence, and respect for reality. A business that refuses to overextend, that builds cash reserves instead of castles in the air, that grows through earnings rather than leverage. That business is not just financially sound, it is ethically sound. Graham saw this as the foundation of rational investing. Because when an investor buys into a company, they are not merely purchasing numbers, they are partnering with values. And so reading financial health was never just about ratios or reports. It was about understanding character, both of the business and of oneself. Here lies one of Graham's most profound but least discussed insights. When you study a company's financial strength, you are really studying your own.
If you chase growth at any price, you reveal your own impatience. If you overlook debt warnings because a company is hot, you expose your own wishful thinking. If you ignore declining earnings because the story is too good, you are not analyzing the business, you are rationalizing your own bias. And so, Graham's discipline was not only a tool for protection, it was a mirror. It forced the investor to confront his or her own psychology. That is why Graham wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." When you learn to read balance sheets calmly, objectively, without letting excitement cloud judgment, you begin to train not just your mind, but your temperament. You begin to see the numbers not as potential profits, but as reflections of reality. And reality, for Graham, was sacred. Graham believed that investing, at its best, was an act of responsibility. He viewed speculation as a kind of moral hazard, the pursuit of profit without regard for risk or truth. Financial strength, therefore, was not only a sign of a company's health, but of its integrity. When management avoids excessive leverage, discloses facts transparently, and values long-term stability over short-term gain, it is expressing something rare: honor in business. And when investors reward those traits, when they choose soundness over speculation, they participate in something virtuous. They reinforce the kind of behavior that builds sustainable economies, not bubbles. In this way, Graham's principles transcend finance.
They become a philosophy of stewardship, of treating money not as a game, but as a responsibility to oneself and to society. Perhaps the greatest paradox of Graham's teaching is this: to make strong decisions, one must learn to be still. The market moves, the headlines shout, the prices swing. But financial health, real enduring health, does not change by the hour. It changes slowly, like the foundation of a building settling deeper into the earth. And so the intelligent investor learns to slow down, to read, to think, to wait, to measure twice before buying once. This stillness, this quiet, analytical patience is not passivity, it is strength. The kind of strength that resists the crowd, the kind that sees value when others see volatility. And that is the kind of strength that Graham spent his life cultivating in companies and in people. In the end, Graham's philosophy of financial health is really a philosophy of clarity. He taught us to look beyond illusion, beyond the stories, trends, and temporary noise to what truly endures. Because in every market cycle, the same truth returns. What is strong survives. What is weak, no matter how popular, eventually fails. So, how do we, as modern investors, carry Benjamin Graham's timeless wisdom into our own decisions? How do we see the financial health of a company the way Graham did, not through the lens of excitement or story, but through the quiet clarity of evidence? Let's return to his principles and translate them into practice, a framework any thoughtful investor can use. 1. Begin with safety, not potential. When you open a company's financials, ask not how much could I make, but rather how much could I lose and can I live with it? This shift in mindset changes everything. Before you calculate potential returns, look for signs of resilience. Is the company's current ratio, current assets divided by current liabilities, comfortably above 1.5? Are long-term debts manageable, less than tangible equity, and ideally covered several times over by cash flow? Have earnings been stable or growing modestly for at least 5 years, not just one? These are not rules of perfection, they are habits of protection. Because for Graham, safety was not about fear. It was about freedom. The freedom to stay invested when others panic. And that freedom only exists when your foundation is strong.
2. Look for earning power, not earning promise. Modern markets adore stories of growth, but Graham taught us that real value lies in repeatability, the ability of a company to generate profits through different environments, not just favorable ones. He would suggest comparing earnings across cycles, not months or quarters, but years. Ask yourself, does this company make money even in recessions? Are profits supported by cash, not merely accounting? Is management reinvesting prudently or chasing expansion for its own sake? To Graham, a business that could endure lean times was far more impressive than one that thrived only in booms. Because endurance reveals what glamour conceals, true strength. 3. Treat every investment as a partnership. When you buy shares, you are not buying a ticker symbol. You are joining a business. And every business partnership, Graham believed, should be built on trust, transparency, and prudence. So read the statements as you would read the habits of a person. Does management communicate openly about risks? Do they conserve cash when times are uncertain? Do they issue stock recklessly, or do they respect shareholders' equity? Financial health is not just about numbers, it's about conduct. A sound balance sheet is a reflection of sound minds. And the intelligent investor, Graham would say, seeks not excitement, but character. 4. Demand a margin of safety. No company, however strong, is immune to error or misfortune. That's why Graham's central doctrine, the margin of safety, remains as vital as ever. It's simple in principle, profound in practice. Buy when a company's price stands clearly below its conservative value. That margin, the gap between value and price, is your armor. It protects you from misjudgment, from volatility, and from the unpredictable whims of the market. In Graham's words, the margin of safety is always dependent on the price paid. By insisting on this margin, the investor minimizes the chances of permanent loss. The modern investor has more tools, data, and models than Graham ever dreamed of, yet no safeguard more effective than that one idea. 5. Cultivate emotional health alongside financial health. Finally, and perhaps most importantly, remember that no analysis, no ratio, no spreadsheet can compensate for an unstable temperament. The true financial health of an investor lies within. Can you hold cash when others are greedy? Can you hold conviction when others are fearful? Can you accept being wrong without abandoning logic? These are not financial questions, they are philosophical ones, and yet they determine more fortunes than any formula ever will. Because investing, as Graham taught, is most dangerous when it feels easiest, and most rewarding when it feels hardest. In the end, reading a company's financial health the Graham way is not about complexity, it is about clarity. You are not decoding secrets, you are looking for sanity in a world that often forgets what that looks like.
Every balance sheet tells a story. Some whisper of discipline, others of greed. Some speak of patience, others of haste. But only those that reveal restraint, the careful balance between ambition and prudence, stand the test of time. And so, when you open a company's report, remember, you are not just reading history, you are reading character. And if you can learn to recognize financial virtue in the numbers, you'll find something deeper than profit. You'll find wisdom. Benjamin Graham's teachings remind us that investing is not merely the pursuit of wealth. It is the practice of judgment, the quiet art of seeing clearly when others are blind. And in that pursuit, one principle endures. Strength is not built in the boom, it is revealed in the storm. If you found meaning in this exploration, if Graham's quiet wisdom helps you see investing with a little more clarity and a little less noise, we invite you to stay with us. Subscribe to Benjamin Graham Value Insights, not for tips or predictions, but for timeless lessons on how to think, not what to think. Leave a comment sharing how you evaluate a company's financial health and which of Graham's principles guide you most. Because together, we're not just studying history, we're preserving a philosophy, one that has outlasted bubbles, booms, and every passing trend. And as long as we remember it, we remain not just investors, but intelligent ones.